Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Dietrich, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Dietrich, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everyone. Welcome to episode 45 of Carson's Facts versus Feelings with Ryan and Sonu. Sonu, we're titling this one, Just Like Everyone Expected, which is playful to the very strong economic data that we saw last week. We'll get into all that stuff. Now, on the YouTube channel, Sonu, it looks like there's some devil horns behind you, but explain that. Those aren't devil horns, right? Those are not devil horns.
No.
Yeah.
I saw a picture of myself wearing it in one of the other podcasts, and I don't know, is that the Disney movie with the what's the name? The Maleficent or Maleficent? I don't know how to say it. But,
I don't either. Yeah.
But these are bullhorns. These are bullhorns, and I'm going to keep it up there until Ryan, you tell me to take it away. So.
Yeah. So that was last week. If you listen to the episode we did with Tom Lee of Fun Strat, we thought we had some fun because Tom's obviously been one of the bigger bulls. Fortunately, very correct there, and we've been bullish also. So Sonu and I broke out some horns. I thought it was funny because I got Sonu like these big, strong-looking horns. Mine were kind of goofy and not so strong-looking. That was part of the joke, though. But that was a lot of fun with Tom. If you didn't listen to last week, definitely listen to it. It's had a lot of downloads and listens. It's probably going to be our most downloaded and listened to ever. I think it's already on the YouTube channel. It's got the most views ever. So anyway, thank you to Tom. That was a great, great discussion last week. But Sonu, the show goes on. One more thing. We're not too far away from 50. We're at 45. No. Assuming we don't miss one here, we're looking at early September. What are you going to do for the Big 5-0? What should we do?
Assuming you make it. No, we'll make it. What should we do?
I think there's clamoring for a guitar solo. I think you might have to break out. You've got 5 weeks, give or take, to figure out something for the guitar. Aren't you? You got some concerts coming up, right? Yeah.
Well, whoever's listening to the podcast can see what I'm holding. I'm holding a pair of drumsticks. So I'm taking drum lessons now too. So just to get some rhythm on too.
Well, maybe we'll do that then. But that's pretty cool. So let's dive in, Sonu. Again, everyone, we're titling this one episode 45. We're titling Just Like Everyone Expected. We're going to take a look at some of the recent economic data, specifically GDP. Sonu really dug in last week with some interesting factoids, again, that show the economy is continuing to surprise to the upside. Again, just like everyone expected. Play on words there. We're going to talk a little bit about August, September, potentially weak seasonality, but we are up 5 months in a row officially on the S&P. Historically, that's pretty strong. So we're bullish. We're still bullish, but we're going to talk a little bit about that. And then we're going to finish things up depending on how much time is left. There was a Fed interest rate decision last week. They did hike. We think it could be the last one. We'll talk about that as well. So, Sonu, let's get into it. We'll start with the economic data. I think the big one last week was GDP. You did amazing work with your daily market update note you send to our more than 350 Carson partners, where you really looked at, I thought, some really unique things. Bottom line, the headline number was better than expected. But I'll be quiet for a minute. What did you find when you peeled back the onion on last week's GDP report?
Wow, there was a lot in there. But just headline, right? The economy, after adjusting for inflation, after adjusting for prices, the economy grew 2.4% in the second quarter. Yep. Expectations were for 1.8%. So that was a big beat by itself, right? Yeah. Now, but this is what's interesting, Ryan. And I think we've talked about this before, but it never hurts.
Sonu, we've done 44 of these. I think we've talked about everything at this point. So I'm sure we have talked about it before, whatever you're about to say.
So you go back to the beginning of, second quarter, April, the median economist, basically, what we call blue chip consensus, right? They were predicting 0% growth. 0% growth. The economy would be flat in the second quarter, right? Some of them have been predicting like the labor market would go, would crash and we'd get negative employment and, all of that, right? And so median economist was predicting 0% growth, that means half of them were actually predicting a negative quarter, Ryan. And for Q2 GDP to be up 2.4%, that's huge, right? So the good part is, look, GDP is made up of a few things, right? It's made up of consumption, investment, government spending, and then you have two volatile parts of GDP, which is inventories and exports, right? Let's set those aside. You over the last year, we've seen every quarter or two, one has a big impact on the positive side, the other has a big negative impact, right? They sort of cancel each other out over time. So set that aside, right? Let's take the big ones, the most important ones: consumption, investment, and government spending, right? This time, the good news is, inventories and exports didn't have a big impact on the headline number. So that was good. So you could sort of take the headline at face value in that, okay, that's the speed of the economy right now. Now, consumption eased a little bit, but that was because good spending eased. Auto sales pulled back a little bit, but services spending are strong, right? We've been talking about services spending since last November, when you started buying Taylor Swift concert tickets, Ryan?
Exactly. Yes.
So, and now she's on the road, right? I just saw, shout out to, I think the folks at Animal Spirits. They were talking about, and Michael Antonelli as well. I saw a link he put up, like, Taylor Swift is like a mini Super Bowl, rolling Super Bowl, city to city to city, which is amazing to think about, right? But it just goes to show, it's not just Taylor Swift. It's like people want to go see Taylor Swift, and they're spending, right? So that services spending is strong. It's eased off a little bit from the first quarter, but look, it's still higher than the pre-pandemic average, right? So it was about 2.1% over the last quarter. Before the pandemic, it was slightly under 2%, right? But this is what was most positive. The big swing, the big contributor for GDP growth in the second quarter was investment, right? Now, we've talked about housing. Part of investment is residential investment. And that dragged for a 9 straight quarter. I thought it would be flat or slightly positive, but, these things can get revised, right? Going forward, I don't think it's going to be a drag, if at all, maybe slightly positive. But then you had non-residential investment. That was a big one. Ryan, I know you follow the Dow transports, but what's interesting is, that it tells you something about how the cyclical parts of the economy are doing, right? If Dow transports are doing well, that means, the economy is pretty strong. And we see that in the data too. It's always nice to get this confirming evidence. So investment in transportation equipment, right? So things like light trucks, heavy trucks, aircrafts, all of that contributed about 0.5% to Q2 GDP growth, right? And manufacturing construction, so building of factories like semiconductor chip plants, all of that contributed 0.4%. That's the largest contribution to GDP growth since 1981. So we've been talking about what a good story manufacturing construction is for the American economy since, for about 4 or 5 months now. And it's nice to see, again, like I said, confirmation in the data.
No, that was great stuff there. I mean, you've been talking about this manufacturing revival that we've seen in the United States. Not many people are talking about it, but we're seeing it. I mean, as I look at some of the notes I wrote to myself, you pointed this out, Sonu. Year over year, GDP is up 2.6% for the 3 years before COVID, 17, 18, 19. Looking back, pretty good economies, I think we'd all agree.
Yes.
2.3% GDP. The economy is actually running above pre-COVID levels, which again, I think would shock. I think the word might be shock most average people on the street if you pointed that out to them, because it's just people don't feel that way for whatever reason, but the economy is clearly surprising. Like you mentioned, CapEx, equipment up 10.8% and intellectual property products up 3.9%. I also see inventory added 0.14%. After taking away 2.14, like you pointed out, inventories are more volatile, but inventory has been a drag the last couple of quarters. Now they could be a tailwind. I know our friends at Renmac have been pointing this out. And like you said, housing down 9 quarters in a row, barely down. It looks like negative 0.16%. So pretty darn close to becoming positive. No final comments from me really on GDP. I mean, just truly another data piece that says, hey, the consumer is still strong. The economy is bottoming, not bottoming. The economy is growing, and there's no recession. There's no recession coming, right?
And let's go back to what you said, right? The economy is growing as fast, if not faster, than pre-pandemic level, 2.6% over the last year. But that's pretty amazing if you think about it, right? Because the Fed just had its most aggressive rate hike cycle in 40 years. They took rates from 0 to above 5%. They just raised rates again last week, right? So, and you think, of course, like it should have had an impact. Everyone is predicting, in fact, those rate hikes would send the economy into recession. Now, I'm not saying the Fed rate hikes didn't have an impact, right? What did it hit? It hit the most interest rate sensitive sector, which is housing, right?
Yeah.
Residential investment over the last year fell 16%. Brian, you just mentioned, residential investment's been a drag on GDP for 9 straight quarters. It's been a massive drag over the last year, right? But see, that makes up only about 4% of GDP. What countered that, right? What went the other direction? 2 big things. We just talked about Taylor Swift, right? But services consumption. Right. Services consumption makes up 45% of GDP. Over the last year, that was up 2.6%, which is pretty much exactly what headline GDP did. Anytime you want to think about, okay, what's the economy doing? A good idea is to look at what is happening with services consumption. And you get a sense of, okay, that's the underlying speed of the economy. The other thing, government spending, right? We've talked before about the CHIPS Act, Inflation Reduction Act, which is less about inflation. It was more about stimulating manufacturing, construction, and all of that. And then the Bipartisan Infrastructure Act, right? And then state and local governments are spending now. They've got surplus money after the pandemic because taxes are high. Tax receipts went higher because everyone is spending, right? You and I bought goods from Amazon. States and local governments got taxes for that. So they're starting to spend all of that. All of that sort of countered what the Fed was doing. And that's why the economy basically accelerated over the last year.
I'll point out this. I mean, this was one of the more well-discussed, well-telegraphed recessions ever. Now, we didn't have a recession, but literally everyone's been talking about the yield curve. CEO confidence has been extremely low. A lot of companies have been buttoning things up, almost like preparing for this big, massive slowdown. So in a strange way, I think corporate America kind of averted things by kind of slowing the reins down ahead of time before the recession. Because again, if everyone's talking about it, you got to think maybe some of this is priced in. So really unique. Also, I see last week real spending came in up 0.4% versus up 0.3%. Highest increase month over month since January this year, when we saw some big jumps because of better weather. People got a little bit more money and Social Security. Bottom line, again, if you look at just that came out on Friday, Sonu, the consumer is just showing no signs of weakening, right?
Yeah, and I know this is one of your favorite charts. At some point, we'll figure out a way to share charts on this YouTube channel. I know the listeners on the Apple, Google, or Spotify can't see it, but if you go to YouTube, we'll figure out how to get the charts up. But I know this is one of your favorite charts, which shows, okay, what's the pace? How fast is disposable income growing? How fast is employee compensation growing? Because disposable income has Social Security and all sorts of other stuff.
Right.
But forget all that. Let's just take the worker, right? Across the U.S., all workers, incomes are rising at a pace of, about 5%. Actually, over the last year, employee compensation is up close to 6%. By the way, what was inflation? PCE inflation, CPI inflation, however you want to dissect that thing, that was up 3%, right? What does that mean? You take the difference, employee compensation, 5.7, 6% minus PCE or CPI inflation at 3%, the difference about 2.6, 2.7, right? That's basically your real economic growth, or economic growth after adjusting for prices, right? So look, incomes equal spending. I think it's really as simple as that, without getting into things like yield curve and M2 and PMIs and things like that. Just follow what's happening with the consumer.
Yeah, exactly. I mean, I've got the numbers here: 3 months, 6 months, and 1 year later, disposable income and employee compensation are both drastically running above PCE inflation. And again, that's some data that you point out monthly to our Carson partners. It's really nice. Now, what else we want to talk about here on the economy? I guess let's talk about inflation. We'll talk about inflation for a minute. ECI, that's Employment Cost Index, came out, and core PCE, which we're told is the Fed's favorite measure of inflation. I'm not sure if it's true or not. It's what we say on TV. But the bottom line is Friday saw continued better news on the inflation front on both of those. I want you to dive in a second. And just like everyone expected, that's the title to this podcast, that came in better than expected. And again, I've been hearing all the time, Sonu, lately, well, inflation, you see how tight that labor market is. Inflation is going to start coming back up. It hasn't yet.
Yeah, no, not yet, right? And there's good reason to think why it's probably going down even further. But let's just talk about wage growth first, right? Look, the Fed's model is, last year, why did they raise rates? Inflation is really high. How did they think inflation would come down? They thought, okay, if we raise rates, employers are going to start spending less and they're going to hire less people. So the labor market is going to get weak, right? If the labor market gets weak, wage growth will go down. And then, if people are getting paid less, they're going to spend less money, right? That's the model. Mm-hmm. Now, one part of it has worked, which is, let's say two parts of it have worked. Inflation's come down. Wage growth is also coming down. The employment cost index, I won't get into all the reasons why it's considered the gold standard of wage growth measures, but it is, right? Let's take our word for it. It's up about 4% in the last quarter, at an annualized pace. That's down from a peak of 6.5% a year ago. So that's really good, right?
Right.
Now, 4% is still it's slightly above what we saw before the pandemic. It was about 3%, but we're not far away. So from the Fed's perspective, that's good news, right? So wage growth has come down. The good news, Ryan, is that that's happened even as the unemployment rate is pretty much exactly at the same place as it was last year before they started hiking rates, 3.6%. Right. And so there you have it. I mean, you talk about somebody's model has to be rethought here, right? And then you think about inflation. Inflation's come from peak CPI inflation was 9% last year. PCE inflation, which, as everyone says, the Fed prefers, now peaked at about 7%. They're both down to 3%. In fact, headline PCE actually has a 2 handle by that, it was up 2.97%. So I'll go with that, Ryan. As opposed to the 3% round off.
Right.
But look, that includes food and energy, right? That's why inflation's come down a lot. The Fed focuses on core inflation without food and energy. Hey, in June, by the way, core PCE, I know with 2 decimal places, we're kind of, getting really nitpicky here. But core PCE was up 0.17% in month over month in June. Why I bring that up is if you annualize that, that's exactly 2%. That's the Fed's target. Core inflation is coming down. That's the big story here. And in fact, going forward, I think it'll come down even more because of housing and vehicle prices.
I'll one up you, Sonu. According to my notes, it was up 0.165%. So again, you only went 2 decimal points. I've got 3 decimal points. But again, like you said, that is yeah, there you go. That's what you get on this podcast. 3 out to 3 decimal points. So maybe we should rename it out to 3 decimal points. But anyway, the bottom line again is these themes that we've been talking about all year: a better than expected economy led by a strong consumer, strong consumption, decreasing inflation, real wages are actually going higher, real incomes are going higher, disposable income is improving. All of these things are leading to, again, an economy that could surprise the upside. One final comment on this. I've got and I always butcher what this is called, Sonu, so help me. The Atlanta Fed GDP now, is that it? Did I say it in the correct order?
Yes.
Sometimes, anyway,
That's
close
correct.
enough for government. Close enough for government work, as they say. Expected, at least as of late last week, I don't think it's changed much. 3.5% GDP expected in the third quarter.
Wow.
Yes, it can be volatile. Yes, that might not come in at that level. But boy, oh boy, that is impressive. And my take is this: stocks tend to lead the economy. Believe me, we can find points it hasn't worked. I get it. But most of the time when you see strength like this, my personal opinion, our opinion on the team here is probably that strength we saw earlier this year in stocks that we talked about is sniffing out a better economy second half of this year. Sonu, the thing you've been saying for 6-7 months now, but I think people are starting to catch on. Sonu, we're well over halfway done, but we wanted to dig into this. Anything else on the economic data from last week that you wanted to? earnings. Want to touch on earnings for a minute?
Yeah,
or two?
Yeah. Because I think
let's
it's a
wrap
good
up.
connection.
Yeah, we'll wrap up with earnings, and we'll talk a little bit about kind of August and September. So earnings overall, it seems to me like pretty darn good. I mean, Meta and some big companies have had some really strong results. Yes, there have been some losers. There always are. But overall, looks pretty positive, right?
Yeah, I think over 50% of the companies are reported. And by the way, like we always talk about the economy, and it's always sort of like it's not exact, like it's not perfectly clear how the economy is connected to stocks. Sometimes more often than not, stocks tend to lead the economy. Sometimes it doesn't. You're like, why bother with the economy at all? But look, we started the podcast talking about the economy. Everyone's talking about the economy. Last year, Jamie Dimon was saying we're going to face an economic hurricane. That hasn't happened. But everyone cares about the economy, right? I like to think of it simply as the economy is where profits come from, right? And the stock market cares about profits, right? So getting to, and which gets to earnings, I think out of about 51% companies in the S&P 500, 80%, Ryan, have reported earnings surprises. The 10-year average is 73%. So that's really positive. 64% of companies are reporting revenue surprises. So here's an interesting stat, actually. So about half, maybe 60% of, or maybe 40% of companies earn more than half their revenue outside the US, right? For those companies, the revenue is down about close to about 21%, right? This is including those that reported plus estimates for those that they haven't, right? For companies with more than 50% revenue outside the US, earnings are expected to decline about 21%. Whereas for companies with more than 50% of revenues inside the US, we're about 0.5% earnings growth year over year. So that's a big difference between, and it tells you something about how well the U.S. economy is probably doing relative to everybody else, the rest of the world, and plus some effect of the dollar too. If the dollar is strengthening, any revenue you get outside is going to look smaller, just by the nature, by the currency appreciation thing.
Exactly. We've talked about that before. Last year, the strong dollar probably was a headwind to earnings, anywhere from 5 to 8%. There's no exact way to, well, maybe there's an exact way, but we're doing an estimation there. But now we've had a weak-ish dollar this year, potentially a tailwind. All right, so Sonu, great discussion on the economy. Let's talk about X for a second. So Twitter is now called X. It updated on my phone. Do you see that? X. That's what we call it, right? X. Is that what it's called now?
So here's where it gets really confusing for me, because I have, like, if you've ever seen my computer, you probably see that I have about 30 to 40 tabs open at a time on my browser. So it's embarrassing. And I think some people think, like, what is even wrong with you, right? But so, like, I usually have at least 2 or 3 Twitter windows open. And usually, in the tabs, obviously, when you have so many tabs, there's no name. It's just it's just a label. It's a symbol, right? Sure. And that symbol used to be the bird, so I knew it was Twitter. Now it's like, it's X, and I have to, like, what is that X? And I'm looking for the Twitter, bird, and I can't find it. And I'm looking through all 40 tabs trying to figure out, okay, which one's. Well, I guess it's not. Is it Twitter? Is Twitter or is X? It's X right now.
It's X. It is X. I don't know if they're going to bring it back or not. People were asking, like, when's the last time a major company truly, like, changed their name and made a. It still seems to work the same, I guess. Anyway, very, very interesting.
For now.
Yeah, for now. So, I mean, we'll see. But, I mean, I actually was finally verified. It took almost 3 months. I did the thing.
Oh, yeah, congratulations.
I literally had to, like, contact, like, executives from Twitter. I was DMing them saying, listen, people are buying this. Within a couple days, they've got their little check mark. Why can't I get one? I've got so many fake accounts, and I know people listen to this podcast. A fake Ryan is probably trying to sell you something. Apologies. I'm like, give me my check mark. So it took a while.
I think I follow fake Ryan on Instagram, by the way.
Oh my goodness. What am I up to? I don't even know. I don't do much on Instagram, so I don't know what I'm up to over there. But anyway, so very interesting what's going on in social media. But I mean, I love using X/Twitter for a lot of information, and we'll continue to. But very interesting. All right, Sonu. So let's go. Let's see here. How are we doing time wise? We're doing all right here. We got a little bit more time.
Let's talk stocks.
Yeah, let's do that. So August and September. Believe me. Sorry, I get choked up talking about this. Apparently, August and September historically can be a little potential troublesome. August, if you look at the last since 1950, only 2 months are worse on average. February and September, last 10 years, not all that great either. Last year, a real rough August. Now, last year, different scenarios. And now, let's be clear. But, when you also have at least a 5-month win streak heading into August, Sonu, it's like almost a coin flip if August is higher with some decent drops. I think the final comment here is this. When you're up at 17.5% or more for the year going into August, so a really good year. August actually does worse. Only higher 3 out of 11 times, down about 1.1% on average. So believe me, we are still overweight equities. We still think that stocks will be higher from the second we are right now to the end of the year. But I think it's just it makes sense to be open to the idea that maybe there could be a little pause. And let's not forget Mike Wilson does a lot of cool work at Morgan Stanley. He's offering like apologies last week for being bearish and obviously being incorrect. Some other bears have made some calls like that. That contrarian in me wonders that the bears are saying we're sorry. And now we're entering a seasonal weak time frame. Maybe you could have, maybe there's a chance you could have a little weakness. But I don't think it'd be much more than 5 to 6% personally, and that could happen quickly and be a buying opportunity. I mean, Sonu, I said a lot there. What's your take on some of those concepts that we just discussed there?
I mean, the market's up. About the S&P is up about 20% thereabouts.
Off the October lows is like 28 or 29. I mean, off the October lows is like 20. Right. Yeah, off the
Right. Yeah. So safe to say that this is not like a bear market rally or anything like that. I think safe to say we're out of that. as you said, we're bullish, right?
Mhm.
And here's the question I want to ask you. If you want to put some more, if you want to, go into equities a little bit more, right?
Mhm.
Would you do it now or would you wait?
Mhm. Well, that's a very good question. I always like to say do half now and half in a little bit. That way you don't have to pick one. You kind of have your
Sure,
bases
right.
covered.
Yeah.
I mean,
That's
honestly,
what
hopefully,
I'm,
if you've listened, if you've listened to this podcast, hopefully you've been overweight for a while now because it's like up 29%. I mean, so it makes it tougher. But the concept that we've talked a lot about, I feel like a broken record, but the movement of the market, the message of the market. We know tech communications had a great first half of the year. I mean, just last month, small caps are up over 6%. Energy has just been going crazy to the upside. We've been talking.
Yeah.
We're overweight energy. We're overweight industrial. Those have been our two favorite groups for a couple of months now. We're seeing the strength from those groups, the broadening out. So those areas I still think can have some strength. I mean, again, if you look at like energy stocks, okay, Sonu, they're like where they were in 2008. Okay, like 15 years, energy stocks, if you could say, gone nowhere. Now, yes, they had a great rally the last couple of years, but they were decimated during the pandemic. Remember when oil was negative $38 a barrel? Energy stocks didn't like that, plain and simple. But now they've gone nowhere for 15 years. Maybe there's still a lot of potential upside to some of these cyclical value areas. I've been saying I kind of like materials. We're more neutral that, I guess, from the Carson House views. And they're only about 2% of the S&P 500. So let's be very clear. But all of a sudden, earlier discussion, Copper is like breaking out. Copper showing strength. Copper very well could potentially keep going higher. Dr. Copper. So goes copper, goes the global economy. I'm not sure it's quite that simple, but stronger copper probably is a positive thing. So we're seeing some of these cyclical areas that still look really nice to me that, maybe you can still add some there and have some appreciation. Final comment on this discussion, Sonu. S&P's up 5 months in a row. In 2001, we had a 7-month win streak, I believe, in 2001. What happens next? 1 year after a 5-month win streak on the S&P, the S&P's been higher 26 out of 28 times, up 12.5% on average. Now, here's the kicker. There's always a kicker. The last one, and that was in 2001, stocks were down like over double digits a year later, by far their worst return ever. But normally, a 5-month win streak tends to resolve higher, similar to many, many of the stats we've been talking on this very podcast last 7 or 8 years. That's, last time this happened, tend to go higher. We're still seeing those. Final comment, when you're up 5 months in a row, the next month, so that'd be the 6th month, has been higher 79% of the time. So we just talked about August, maybe a little trouble, but now I'm talking out both sides of my mouth like any true technician here or any true strategist. That normally you do get to that 6 months, but again, we're going to have a down month eventually, everybody. You can't go up every month, but we're still bullish. But just some really interesting concepts, I think, to talk about. Put a bow on this. The movement to the cyclical areas of the market is something we were talking about for a while. We like that. Small caps just made a 52-week high yesterday, relative strength breaking out. Mid caps have been really strong. So these areas that have lagged, I don't see too many people on TV talking about these areas still. Okay. So I think there's still upside appreciation of those areas. Go ahead.
No, I was going to say this, what you said about energy really stands out. And I think I saw the chart you put on X. I was going to say Twitter. X, I guess. There you go. You seeded it out, but
yes.
If you think about energy's at 3 big crashes, right? Like you think about the last 15 years, 2008, obviously everything crashed and energy crashed with it. Then you had the 2016 crash as well, and energy went down, and shale, there was that shale bust and all of that. And then negative oil in April of 2020. So 3 big crashes. So, and then you think about, energy had a massive year last year, but it feels like it doesn't have to end there because, hey, you look back 15 years, it's flat, right? So no, we definitely, I think there's reasons to be positive about energy. Just, from my perspective, if the economy is doing well, demand for energy is going to increase, right? And we are not yet in that stage where we're just using renewables or anything like that. If anything, traditional energy sources will be that transition fuel, so to speak. So I think there'll still be a lot of need for energy, even as supply is sort of constrained, right? So a lot of positive stories there.
No, absolutely. Let's go. We're going to talk about the Fed in the final couple of minutes here. We're kind of near the end of the road. Your sister just visited from India, and I know, hopefully you're okay to talk about this on air. If you're not, just tell me to shut up. But I know you went to the doctor with the baby. You want to take it from there?
Yeah, no. So in India, for various reasons, obviously they're not allowed to find out the sex. I hope I don't get into trouble here, but no,
That's what I was
don't think
wondering. I hope we don't. Do they listen? Does anyone listen to this podcast?
in the Indian government. Let's assume they don't.
The Indian government. Okay,
yeah.
Okay.
So no, I think it'll be fine. I won't say her name, so we'll leave it as that.
There we go.
I don't think you'd. No, we had to find out the sex of the baby, and well, she's having a boy, so fantastic, and I have a boy and a girl. You have 2 boys and 1 girl, so it's nice to mix it up. This is her first child, so it was really exciting in several ways. But yeah, the whole thing was special in ever so many ways. What was interesting is her husband didn't come with her. Yeah, didn't visit, right? So she was just by herself, and she didn't want to tell him until she went back because she wanted to see his reaction, right? So she knew for a good 2 weeks or so before he knew. So that was just interesting, and so he's excited, and
she's told him, right? I don't want him to hear on the podcast from us.
No.
I mean, he needs to hear from her.
She's told him. She's told him.
All right. Okay, well, good. Well, I know that was fun. I'm glad she's home. When's the due date? When
December 19th. December 19th. You never know with these things. It's interesting. Once you get to that part of December, it's like, oh, will it be a Christmas baby, right? I mean, I knew somebody with a Christmas birthday, and that was a bit of a double-edged sword, right? Because you're like, everyone's celebrating Christmas and not my birthday.
Oh, I think as a kid, I don't think I'd like that. I hear you. Yeah, you feel left out, but maybe not. Maybe it can be special too. So, all right, Sonu, we've definitely gone to near the end here. Let's spend like 2 or 3 minutes on the Fed. The Fed did hike interest rates for the 11th time from 0% up to 5.5% now. You've written extensively, talked about why, the hiking they had, it upset the apple cart, it hurt the mortgage market, hadn't hurt the consumer like we talked about, or housing market, I should say, and mortgage market. Why do you think this is the last hike, though? Or at least odds on favor to be the last hike?
I think so. Powell had the press conference after the Fed statement. I think everyone's read the Fed statement as sort of hawkish. Again, everything's unbalanced, right? Slightly hawkish. I mean, so, and Powell is very careful to say that taking each meeting at a time, data dependence, of course, before the next meeting is 6 weeks from now in September, you're going to get 2 more inflation reports, 2 more employment reports before that.
8 weeks. It's 8 weeks, right?
Oh, it's 8 weeks.
Oh, remember that? It confused me. It's 8.
Yeah.
I don't know why. I always thought it was 6, but it's 8. Anyway.
I thought it was 6. You learn something new every day.
There you go. And it's 8. Yeah. It's what I'm here. It's what I'm here for. Yeah. Master of the calendar. No, I'm not. I missed a radio interview last week because I screwed up. So believe me, I'm by no means am I master of the calendar. But anyway, continue. Yes. Sorry.
Yeah. None of us, I should look at the calendar more often than I do, actually. Or my wife tells me that. So anyway, Powell is kind of 50-50 with respect to, another rate hike in September. But when he starts getting questions, what's refreshing about Powell is sort of his openness comes out. He doesn't talk like economists speak, like, the last 3 chairs, whether Greenspan, Bernanke and Yellen too, right? Powell's not an economist. So sometimes it just comes out, right? And I think his on balance, for what that's worth, I thought it was on the dovish side, right? He says, look, inflation's moderated, even as the economy remained resilient. We saw the numbers. Unemployment rate is at the same place, as I said, when they started. It was at 3.6%. Most importantly, this is it, right? He said, I think this can continue. Now, what does that mean? If core inflation comes down, even if the economy stays strong, even if wage growth is 4%, which is where it is now, be like, okay, maybe, we don't have to keep hiking rates here. He didn't mention anything about reducing rates, right? I think that's still some ways out, maybe at least 8 months out or something like 8-9 months out from now. But, I think they're done with rate hikes, mostly because, I think core inflation is going to come down. We've talked about why before, but I think vehicle prices are going to come down. That's going to push core inflation lower. Housing, rental inflation, right? That's coming down. The latest data from Apartment List showed rents, are going down. It's negative 1% year over year in July, right? So that's going to feed into official inflation numbers, within 6, 8, 12 months. I mean, 12 months from now, we could see core inflation at 2%, or dare I say, Ryan? I mean, I don't want to get too ahead of myself, but I will. I think we could see core inflation below 2% because of shelter.
Mm-hmm. Yeah, those are some things Tom Lee talked about last week, actually, on the podcast, if we're going to go back and listen. So I think that's a great way to sum it up. We think the Fed is likely done hiking. Economy is still strong. Consumer strong, just like and the stock market's going just crazy to the upside, just like everyone expected. Back to the title of the podcast. Now, I mean, we've been bullish.
I have one more.
Yeah.
I have one more
Go ahead.
thing. Like
Let's
going back
hear
to
it.
the horns. By the way, my horn. Bell, I guess whoever's listening can't see it, but my horn it's broken, but it moves, right? So that tells you a degree of bullishness. But I was talking about. So our producer Chelsea just told me how to pronounce. It's Maleficent. Maleficent.
I think you still messed it up. I think you still messed it up. Yeah. Maleficent? Maleficent? I don't know. Yeah.
Okay.
Well, you know, we can't get it all right. You know, hey, we've been bullish. Give us some credit for that. We can't pronounce our Disney movies. I remember seeing that back in the day. I think they made two of them, right? I think they made two of them.
I have no idea.
And Jolie, Angelina Jolie, right? She was.
Oh, it was
in
okay.
it, I believe. Yeah.
So was that related to Snow White, or am I getting my Disney?
We're going to come off like complete fools here because I don't know. I'm pretty sure somehow there's a connection to the world of Snow White, but honest to goodness, I don't really know.
Okay.
I'm worried about did I spill food on my shirt before I did the podcast? That's the stuff I worry about. So anyway, keep it simple.
Safe.
All right. Well, everyone, thank you so much for listening. Thanks, Sonu. Thanks, Chelsea, our producer, to help us here. This is episode 45 of Carson's Facts versus Feelings. Just like everyone expected is in the books. We'll be back next week. Take care, everyone. Thank you.